Welcome everyone back to FX Street. It's 8:30 a.m. Eastern. Today is July 5th, 2011. Hope everyone had a great 4th of July. Welcome back to FX Street. Great that you could join us. My name is Adam Rosen. We have a very fun topic to talk about today. On the surface, it might not look like it's fun, but it is. What we're going to talk today about is building a trading plan through the use of gaining evidence. Actual trading evidence, where we can look back at our results and say, okay, we made money doing this and we lost money doing that, so it's better if we do this. That's a little bit of oversimplification. Before we get started, really briefly, just a couple pieces of news. The Reserve Bank of Australia left rates unchanged today as expected at 4.75%. That was earlier today. But in addition, the RBA Governor Glenn Stevens said the nation's growth pace may be weaker than previously forecast, and that was in part responsible for the Aussie selling off. Most of the time with these central bank meetings, we will not get any kind of change. Most of the time, they're expected to keep rates unchanged. They leave interest rates unchanged. And in fact, even when most of the time when the central bank does adjust interest rates, it's widely anticipated, so there's not really a fantastic trade out there. What really are the best ways to trade these central bank meetings is to look for these little tiny shifts in the nuance from, what did the European Central Bank president say? He went from diligent at fighting inflation to, or vigilant to diligent, something along those lines. These little changes in the language can lead to much, much more. So the Aussie selling off early today could be just the beginning. Now, obviously, we have to take a look at the charts and, everything else involved, but do not discount one little change in the language by a central bank, because sometimes these big trends begin with a little change in their language. In other news, European retail sales declined the most in more than a year in May. And this is accredited to consumers from Germany, Ireland, and Spain, obviously cutting their spending. Sales in the 17-nation Euro region slipped 1.1% in April when it rose 0.7%. Now, the retail sales is not a huge number, but it's one component. And as we continue to see the inflationary numbers come out, low, the unemployment rate remains high, which it has recently in the Eurozone, all this adds up. So again, don't discount a little piece of news because it could lead to much, much more. Now, let's get to the topic of the day, which is very simply, here we'll discuss the use of demo counts and technical indicators in creating a trading plan. Now, we all hear about a trading plan, and all the top traders always recommend a trading plan. What exactly is it? We say, okay, I have this amount of money and I want to trade in the foreign exchange market, and I don't want to take too much risk, but I do want to make a lot of money, and I always want to be right and I never want to be wrong. That unfortunately is not a very cohesive trading plan. The trading plan, I think, should be built from the evidence that it shows, that it results. I'll give you an example. I use a number of different technical indicators. One in particular that I, was convinced. I basically knew this technical indicator in and out. I had made money with it. I'd lost money with it. But out of curiosity, one day I decided to go back and really sit down and pull this indicator apart. And this could apply to anything. It applies to the RSI or the Bollinger Bands or the Fibonacci levels or any number of proprietary indicators. Anything that we use to make the decision to get into the trade. That's a technical indicator. I'm going to buy because the RSI did this. I'm going to sell because the Bollinger Bands did that. I read recently, actually, I've read this quite a few times, but recently I reread an interview from a very well-known trader, one of the best. And he said that most people had spent as much time, most traders that spent as much time on risk management as they did on the technical indicator selection, meaning the reason why we're going to get into trade, then there would be a lot less people that lost money, a lot more people that would make money in the market. In other words, most of us, myself included, I think the brunt of our time is spent trying to find that perfect signal to get in a trade. I'm going to buy the euro dollar because, this line crossed that line. I'm going to sell the dollar yen because X, Y, Z happened. And it's natural for us, as human beings to look for a cause and effect type of relationship. Say, well, the market went up, and when the market went up, I noticed that this indicator also, went up. So maybe the next time the indicator goes up, the market will go up again. But we fail to focus in on the risk management side. But getting back to what my experiment entailed, I was focusing on the front end of the trade, which in other words is, trying to find out the reason why we should get in the trade using this technical indicator. And I placed on a demo account, I think like 150 trades over the course of a couple weeks, a good amount of statistical data. And I kept track of every single one of those trades. If you can imagine, I kept track of it all on an Excel spreadsheet using different stop and limit order combinations, different times of the day, different other indicators, secondary indicators to complement these trading indicators. And I was so surprised what the results what the results showed. The long trades, I think they were 44% profitable. The short trades, 48% profitable. And neither one is really anything spectacular. So that obviously is not a good filter. And that will change. When the market trend goes down, the short trades will make a little bit more money. The long trades will lose money. Well, then I try to use a secondary indicator to say, well, if I'm going to buy when it's oversold oversold and sell short when it's overbought, I should use another indicator to really try to refine those overbought and oversold levels. And this second approach, my second idea, before I had gone through actually forward testing this strategy, I was convinced this was the way. I mean, I would place trades based on the fact that, it looks like this has to be the right way to trade. I mean, I'll give an example. Any chart. Throw up the Aussie dollar chart. We go to Bollinger Bands. I'm just picking this at random. Any indicator. The simple moving average is the center line. It's a 20 simple moving average, and then we have the upper and lower bands. We generally, during range bound markets, we're going to buy near the lower band, sell near the upper band, maybe take profits in the middle. Of course, trending markets, it's a different type of trading situation, a different set of rules. But, imagine that for a moment that the market was always range bound. Some markets are like more range bound than others. If I showed you this chart and I said, well, this strategy to buy in the lower band and sell in the upper band, place your protective stops below the lower band and above the upper band, take profits in the middle because most of the time the market comes back to the middle, you, like me, would probably assume this strategy probably makes money over time. I mean, why wouldn't it? It looks like, over the past couple, months actually, buy low, sell high, buy low again, sell high, buy low. It looks like the strategy will make money, and I don't know if it does. I mean, it very possibly could. I've done a lot of testing with the Bollinger Bands, and what I can tell you is that an approach that simple doesn't work all the time. It makes some money sometimes and loses money sometimes. You would need further information to filter down the trade ideas. They came back to my experiment. Like I said, I placed 150 trades with all different types of scenarios, but using the same indicator as the trigger to get in. The long trades are 44% profitable. The short trades 48% profitable. Neither one, had any good results. Secondary indicators, the use of those do not help either. Trying to buy the weak currency pair, it was 45% profitable. Trying to buy the strong currency pair, 46% profitable. Neither one made any sense. I use different stop and limit order combinations. We use a 30 pip stop and a 30 pip limit, 40 pip stop, 40 pip limit, 50 as well, and also combinations of that. 30 pip limit, 50 pip stop, vice versa. You can imagine all those different combinations. We looked at every single different combination, and the best results, I think, were a 50 pip stop, 50 pip limit. But even those results, at best, were barely 50% profitable, and that's not good. Because we're using a 1-to-1 risk-reward ratio. We're risking 50 pips. We're trying to make 50 pips. We have to be better. We have to be right more than 50% of the time. Well then, and just really out of frustration, I was just basically about to give up on the indicator, and then I went back into the data, and I started to sort the data by the time of day. What time of day did I enter the trades? And I found something that was unbelievably shocking. I've always kind of had the suspicion that this was true. I didn't suspect it would be this accurate. And what it was I focus in on the time of the day, the actual hour that you place the trade. And I've talked about this in the past. That the trades that I place during the active hours in the U.S. is from 8 to 10 a.m. Eastern. Those trades, I believe, were 80-something% profitable. The trades placed from 9 to 10 a.m. Eastern were nearly 90% profitable. 8 to 9, 9 to 10. First 2 hours of the trading session. Once those 2 hours had passed, I figured, well, 10 to 11, the market's, petering out, and it should still give me some good profitable trades. Only 13% of the trades placed between 10 to 11 a.m. Eastern were profitable, and from 11 to 12, not one single trade I placed made money. The statistics significantly changed. And if I had not gone through that exercise, I possibly would still be taking trades, reacting to trade signals I should not be reacting to. And this is an indicator that I felt very, very comfortable. Yeah, I know how this works. I need to look at, I thought that I should use Fibonacci levels. I thought I should use other trend lines, and I knew the time and day was important, but we all talk about how important it is. But it really is the most important factor in this particular setup. Point being is, without going through the exercise of placing these trades in a demo count, I never would have known. For the longest amount of time, since the beginning of time that I became interested in the foreign exchange market, I've always traded demo counts. It is the number one best trading tool. If you're ever curious, if anybody ever asks you, what's your favorite indicator? What's your favorite trading tool? What is it that you have used, that we have discovered that works best in trading? My answer to you would be the demo counts. I know all the brokers, offer them, and we all think, well, the broker gives us a demo count because they want us to trade, they want us to see their beautiful platform, and that's true. Brokers, they're out there to make money too. They should be. But just simply as a tool of statistical testing, the demo count by far is the most effective trading tool that we can use. And I highly recommend, you can keep track with a pen and paper. I love Microsoft Excel. Open a demo count, trade the demo count with, the same position size for all the different trades, one standard lot, one mini lot, doesn't matter, as long as it's all the same. And keep track of those results in an Excel spreadsheet. Very simply, you can put the date, the time of day if you wish, the currency pair, as much information as you choose to maintain that demo count. Place as many trades as possible in a 30-day demo count. 100, 200, 300 trades. At the end of the month, we can look back, and the beauty with Excel is you can sort the data any number of different ways. You can look at the data from the time of day. You can look at the data from currency pairs. And this approach with me and my obsession with statistical information started well before trading foreign exchange. In the old days, I used to trade stocks. I was a full-time stock day trader. And I would have good days and bad days, and I've kind of noticed some nuances in my own trading, but I was never really, couldn't put the nail on the head, so to speak, hit the nail on the head. Well, I started keeping track of my results, day trading stocks. I found something very, very interesting. I found that statistically, the worst day of the week for me day trading was Monday. Some of you might find this runs pretty similar in your own experience as well. The worst day of the week for me day trading was Monday. The best day of the week was Wednesday and possibly Friday. Now, Wednesday, I don't know why. Maybe there's economic numbers that are usually released on Wednesday. I think it has something to do with the fact that, when I was day trading, I would find that I would come in on Mondays and I would sort of forget all the lessons that I learned the week before. And it would take me a couple days to trade again, to remember simple things about looking for the bid and the offer and the volume. And this is trading stocks, so the rules are a little bit different. But on Monday, for some reason, I'd forget everything that I learned. And then Wednesday, I would tend to have big days. And Friday, maybe because Fridays tend to be very, very directional. Once the market goes up on a Friday, it usually continues going up on Fridays because there's no more trading after Friday afternoon. And Fridays, again, would be most profitable. So what I started to do, and really, I added up all my Mondays. I think overall, I lost money trading Mondays. So I would start trading Mondays. I would trade with 100 share positions, the smallest position size I could. I said to myself, if I'm going to lose money on Mondays, I'm going to lose the least amount of money as I can. And trading 100 shares, and maybe I'll lose a couple $100, and then I can build my position sizes over the course of the week. So my better days, I can trade bigger position sizes, 500, 1,000 shares, more. Would the times be similar for the London Open times? With that particular experiment, I didn't test the London hours because I had to sleep, actually. But I did test full U.S. and Asian hours. In the U.S., it's from 8 to 10 a.m. Eastern. In Japan, it was 7 to 8 p.m. Eastern, only 1 hour in Japan. London, I'll tell you two things. First of all, I would say, without running through the experiment, I would say London would be 3 to 5, 3 to 4:30 a.m. Eastern. The best hour, I'm guessing, would be 3 to 4. But in addition, and I'll try to find an example to show you, it doesn't always happen, but there's a phenomenon that occurs in a London session. We know the London officially opens at 3 a.m. Eastern. Well, the hours between 2 to 3 a.m. Eastern are very, very tricky. Oftentimes what happens is the market moves in the opposite direction. I'm trying to find an example. 8:46, my clock, 12:46. So 3 plus 4 is 7, right? So we'll draw a line here. In fact, this is a pretty good example. All right. I hope everyone can see this line. Let me change the color to white. Okay, so from 3 to 4 a.m. Eastern, from 2 to 3 a.m. Eastern is the hour before trading starts. And it is a phenomenon that's known by many, many traders. It's one of those old wives' tales. I think it holds true. And it says that basically if the market's going down in the hour before London opens from 2 to 3 a.m. Eastern, there's a very good chance the market's going to reverse and go back up, starting at 3 a.m. Eastern. If the market's going up between 2 to 3, then at 3 o'clock it'll reverse. Now you could say this about any market, right? In the U.S. session from 7 to 8 a.m. Eastern, maybe the futures are going up, but once numbers are released at 8:30 a.m. Eastern, the market reverses. That is true to an extent, but it is certainly not as true as what we see in the European trading session. Please be very, very aware of that. We get lulled into this false sense of complacency. We say, hey, look, the market's going down. This is the pound-dollar 5-minute chart. The market's going down. It's going down. It's going down. But at 3 a.m. Eastern, which, by the way, is exactly where this white line is, we tend to see reversals. In fact, that white line at 3 a.m. Eastern came within a couple candlesticks and a couple pips of identifying the ultimate low in this move. And that was here in 159.90. That's 110, 120 pips. Some call it the Asian trade. Some call it the Big Ben trade. Some call it, I like to call it the London flush, because it flushes all the traders out before the market reverses position. So yeah, I would say 3 to 4, 3 to 5 a.m. Eastern. But also I should say, keep in mind that 2 to 3, you oftentimes have a counter trend move. 9:30 a.m. Eastern, you usually see a reversal. That is true in the U.S. because equity markets, stock markets open up at 9:30 as well. This London reversal is, at least in my observation, very much more predictable though. It's a lot more predictable than the U.S. Open. The U.S. Open, sometimes the future's going up, the stock market opens, and the futures go up more. Sometimes it reverses. Okay, so let me show everyone something that I've put together. Okay, so number one, we talked about our demo counts. We talked about how important it is to get that statistical information. Well, this is a demo count that I put together a long time ago. And very simply, I'll be happy to share with everyone these Excel sheets. If at the end of the webinar, I'll tell you how to get them. But basically, this is the idea I had in mind in terms of testing a demo count. We have the 4 major currency pairs that we like to test. And by the way, when I ran that statistical testing on that one indicator with 150 trades, over the course of 10, 12 trading days, what I did was I focused on all the yen crosses and only the yen crosses. Dollar yen, euro yen, pound yen, Aussie yen, Kiwi yen, CAD yen. Not even the Swiss yen. Euro yen, pound yen also. I wanted to test this idea on similar currency pairs. I would classify a similar currency pair as a number of currency pairs that all of them share one common pair. So with the dollar, pick 4 currency pairs. Euro dollar, pound dollar, Aussie dollar, dollar CAD. We could take dollar Swissy. That oftentimes moves very, very closely in the opposite direction to the dollar, to the euro dollar, so I took the dollar CAD. The dollar yen is a really difficult currency pair to trade. But Vishal, this goes right into your question. When selecting the currency pairs, I think that it's important to find a number of currency pairs that have a common thread, because currency pairs ultimately, you ever wonder why a stock trades the way it does, why a currency pair trades the way it does? When you look at the stock market, you have a stock like Apple Computer, $300 something a share, tens of millions of outstanding shares, a very small float, or I should say, a very large float. The float is all the outstanding shares that are actively traded that are not held by insiders. And the larger the float, it means basically the more smooth the stock trades. When you have a stock that trades tens of millions of shares a day, it trades in a very smooth fashion. When you have a stock that trades 3,000 shares the whole day, when one buyer of 1,000 shares comes in, that can make the stock literally gap. Well, currencies work in a similar fashion, not so much in terms of volume, because we know all the currencies, even the Kiwi, which I think has the least amount of volume, still has an enormous amount of volume. But a currency pair will behave as a result of the two currencies within the pair. The euro and the Swissy, not now, not these days, but historically has been a very quiet, sleepy currency pair. And that is a result of the euro and the Swissy. Generally speaking, they go in the same direction. Like I said, it doesn't happen now because of the influence of gold and what's occurring in Greece and other parts of Europe. But generally speaking, the euro Swissy is a very quiet currency pair. The Aussie yen is the opposite because you have very high interest rates in Australia, very low interest rates in Japan. It's a very directional currency pair. If I'm going to trade the strategy, those directional currency pair, the Aussie yen, euro yen, pound yen, is going to behave a lot differently than the euro Swissy, pound Swissy, and euro pounds. When you take currencies, and both currencies come from the same geographics or political interest rate environments, that's a boring currency pair, like the euro Swissy, euro pound. When a currency pair is made up of two different currencies from different economic, interest rate, political backgrounds, then you have the potential for some real movement, some real strife. 1 hour before London is Central European and Scandinavian hours. The markets are open. That is, you are correct. The other thing, by the way, going back to the currency pair selection, is it might be advisable to focus on those currency pairs where at least one currency is typically active. If you're going to test these strategies in a U.S. trading session, we look to U.S.-based currency pairs, euro dollar, pound dollar, and also the Canadian-based currency pairs. You can trade European hours, take the euro pound, euro yen, euro Swissy, something that's going to react to European news. As far as going over strategies today, well, I'll be happy to show you, to give you some examples. I mean, I wish I obviously had more time to show you more, but nevertheless, we'll make do with what we have. Just to give an example, in fact, I'll give an example based on an Excel sheet that we're going to go back to in a moment. There's 4 indicators that I picked. These are very, very common indicators, available free in all charting packages. And I'll show you very, very simply a way that we could use them. Now, this is a 5-minute chart. I'm going to use a 5-minute chart just because I want to be able to find you trade ideas. Normally, I don't use a 5-minute chart because it's too short term. This is the RSI. There's the indicator at the bottom on the scale of 0 to 100. Indications above 70 are considered to be very strong. Below 30 are very weak. The buy signal occurs when you cross below and back above 30. And the sell signal occurs when you cross above and back below 70. You may consider taking profit somewhere in the middle. Nevertheless, this is an indicator that we would typically, if you want to look for a reversal, to buy when the RSI line crosses below and back above 30, notice the time of the day that the signal took place. The actual buy signal took place a couple hours before, but it came very close to the 3 a.m. Eastern hour. Now, we know what we know from looking at the markets. We know about the London flush, the European fade, whatever you want to call it. As stock markets are prepared to open around the world, oftentimes you see these pre-market or early market reversals. If I'm looking for a reversal with the RSI, I'm also looking for a reversal at a time of day that it's logical we would expect to see a reversal. From 3 to 4, 3 to 5 a.m. Eastern, do not necessarily expect a reversal. Here's from 3 to 5 a.m. Eastern. That's 7, 8, 9. There we go. And the market actually topped out around 9:45. But this is the active session, 3 to 5 a.m. Eastern in London. Now there's another strategy using the RSI during breakout sessions. So when you're looking for a breakout, which we would look for in the active hours, you identify a significant high, you wait for the market to make a new high, and you make sure the RSI is also above 70 as we're making a new high. See how that works? If the sell signal is where the RSI crosses back below 70, what happens prior to the sell signal? It would be a buy signal if we break out to new high while the RSI is above 70. RSI just basically tells us, hey, this is a really strong market. We can use another indicator, such as we have indicators, the oscillator known as the MACD. Whoops, there we go. MACD, moving average convergence divergence, basically measures the 12 and 26 exponential moving averages over 9 periods. But all we have to know what the MACD is, the histogram bars. You want to look for reversals with the MACD, like the RSI. You want to wait for the market to hit a significant low. And you want to see the histogram bars that made lower lows, lower lows, lower lows, start to accomplish higher lows. That reversal is typically a signal of a market reversal. To sell short, we would look for those reversals when we make higher highs, higher highs, higher highs, then we start to make lower highs. Now you may ask, it seems pretty simple, right? The RSI, I mean, why won't I just take trades like this all the time? You absolutely could. Why doesn't everybody use these? Why doesn't everybody make money? I mean, it can't be this easy, and it really isn't this easy because, okay, today we had a pretty consistent open. We had the European retail sales. For some reason, the pound dollar went higher, but that's okay. But if a piece of news is released, that changes everything. If we take this trade at another time of the day, if you happen to, let's say, buy the pound dollar, not between 3 to 5 a.m. Eastern, but almost at 6 a.m., not at 5:45, 5:50 a.m. Eastern, 6 a.m. Eastern, if you would have bought a new high, even as the RSI was above 70, which we just got done saying was the right way to trade, we potentially would have bought the pound dollar at the high of the day, and we would have started to lose money and maybe suffered a stop out. We're not going to know. We're not going to really know what is the right way to trade until we can go out there and get some evidence. No, I mean all these. I laugh because every time you get on a plane and go to Las Vegas, there's always at least one person on the plane that's practicing playing cards or counting cards because he thinks that, well, if I practice for a 3-hour or 5-hour flight, I just need a little refresher. Once I get there, I can, I have a pretty good chance of making money. And we kind of laugh at that. How could somebody practice in 5 hours and compete with, the Las Vegas dealers, the most successful casinos in the world, the place where the best gamblers in the world lose money? And we think that after a 5-hour flight of counting cards that we can beat the casino. We obviously would laugh at that example. But how many of us, including myself, believe me, open a trading account and say, well, I'm not going to do the demo testing, or I did the demo testing and now I know how to use a platform, but I think that the market's really going to move this month, so I don't want to waste those trades on the demo account. Let me just, try to make a little bit of money to start off with. Anything else we do, any other line of work, we would certainly suggest to practice, to refine your technique. You look at professional baseball players, professional athletes, how many years and years and thousands of hours are spent doing the same simple exercise over and over again. So if they get that one chance to play in the major leagues or to, play in the World Series, that they have the best odds of doing so. Why, with our precious trading capital, why would we take any different type of approach? So that's the RSI, that's the MACD, moving average convergence divergence. We can talk about, we talked about before, remember the Bollinger Bands? Indicators, trends, and Bollinger Bands. Bollinger Bands is a 20 simple moving average. It's the top indicator, by the way. Extend to 2 standard deviations above and below the simple moving average. During quiet hours, we tend to see range-bound markets. We would buy near the lower band, sell near their upper band. During active markets, we would look for breakouts. We might buy if the market crosses above the upper band, or sell short as the market crosses below the lower band. Or, if you're not looking for the breakout, because that's a little bit more of a risky trade, if you think that during the active hours between 3 to 5 a.m. Eastern, the pound dollar is going to break out to the upside, I would have wanted to take a position to go long near the lower band. If I thought the pound dollar was going to break down, then I would have wanted to sell short near the upper band. That gives us a much better risk-reward ratio, less risk, more reward. But nevertheless, notice 3 to 5 a.m. Eastern, this is the hours that I expect something pretty spectacular to happen. 8 to 10 a.m. Eastern, well, that's where we are right now. Here's a line for 8 a.m. Eastern. Right now it's 9 a.m. Eastern, so we have another hour to go. So far nothing has happened. But according to the RSI, we're right in the middle, near 50. The MACD is pretty much flat. The Bollinger Bands are right near the center of the range. So there's really not a trade signal right now. But please keep in mind that we do have an active session. And by the way, today's a little bit unusual because the only numbers we have are the 10 a.m. numbers. But that can move the market. I want to get to the other indicators, but I want to get to this question because I don't want to miss anything important. We mentioned about profits and goals and risk. And let's do this. Let's go back to our demo account. And I'll use our demo account analyzer to make money. Well, and there's also moving averages and slow stochastics. There's another different indicators we can use. My suggestion is you take these different indicators. You don't have to take all of them. You can take one if you want. But with every indicator, trade 3 or 4 currency pairs. Trade it for a full month. You need to have a lot of statistical information. You've got to have hundreds of trades so that the information that we get, after you get this information, I'm just entering numbers I'm making up here on the spot. After you get that information, you're going to place trades in live money. So you want to have as many pieces of trade as possible, many pieces of information as possible. Well, in this Excel sheet, what it was basically done with the euro dollar, with the RSI, I should say, in the RSI reversal, which is you buy when we cross back above 30, sell when we sell short back below 70, I just made up these numbers. But if I gave you these numbers, and I showed you, okay, on the euro dollar, the RSI reversal strategy made 300, the RSI breakout strategy made 200, the MACD, we averaged a loss of $99. We made the most in the Bollinger Bands at 487. We lost the most in the MACD, etc. If I gave you this information about XYZ indicator, if somebody gave me this information, well, I would definitely trade the MACD breakout on the euro dollar, and I would definitely trade the Bollinger Bands reversal on the euro dollar, but I would probably avoid the MACD reversal, and I would avoid the other losing proposition, so to speak, the other strategy and currency pair selection where we lost money. Again, why is it important to test this among different currency pairs? You might find that the euro dollar works on a particular strategy and the dollar says he doesn't, or the euro or the pound dollar doesn't. Or you might find that all these strategies on every currency pair we test lose money. Then we know, hey, it's not the currency pair, it's the RSI breakout strategy. Something's not right about that. In terms of the market timing, it's the active session, which is the first 1 to 2 hours of every trading session. For my own testing, I found in the U.S., 8 to 10 a.m. Eastern. In Japan, it's 7 to 8. It's a shorter session in Japan. And that includes obviously Australia and New Zealand as well, barring, numbers that don't occur during those hours like central bank meetings. And in Europe, it's 3 to 5 a.m. Eastern. The first 2 hours in Europe, the first 2 hours in the U.S., the first 1 hour in Japan. Well, I think this Excel sheet proves very, very simply how do we determine what currency pair and what strategy tends to work best. Once we know that, we can go to another Excel sheet that I've prepared and used over time. This is an Excel sheet that, let me expand this a little bit, that we use to measure our risk. Now, risk management, again, is so important. As a general rule, I've always said that you should never risk more than 5% of your overall account on a single trade, idea, or strategy, or market position. If we trade one currency pair at a time, that's fine. If we open, let's say, a $2,000 account, 5% of $2,000 is $100. We can take one mini lot with a 100 pip stop. That's $100. That is what we would risk. If our trade strategy told us to use a 50 pip stop, we could take two mini lots. Now, very important, do not adjust the stop order to allow us to take bigger position sizes. We can't say, hey, I'll use a 25 pip stop order, and that'll allow me to trade 4 mini lots. We'll take the same amount of dollar risk, but we have the potential to make that much more. Yes, but you also have a higher probability of getting stopped out and losing that $100, 100 pips or 25 pips on 4 mini lots. The stop order has to be determined by the charts. What the charts tell us, where should we place a stop? Where do we think the market won't go to? But once we determine our stop order and our position size, well, it's not always the case where we're going to take a position and that's going to be the end of the day. What if we take a position in the euro dollar, we go long here, I'll make up numbers, I don't know where the euro is, 133.50, and we'll place our stop at 132.50. Entry, I don't use decimals here, 133.50, it's not, I know that's not where the euro is, 32.50. Tip value, it's $1 per pip, that's a mini lot. You want to trade standard lots, $10 per pip. I'll leave it at one mini lot. The market position, well, 1 means you're going long, -1 means you're going short. What if I wanted to buy 2 mini lots? I put a 2. Sell short 3 standard lots, -3. Let's keep it easy. I bought 1 mini lot of the euro dollar. Entry at 133.50, the stop order 132.50. Well, now it shows us that we're long 1 unit of the euro and short 1 unit of the US dollar. What if I then have a strategy that tells us to buy the pound dollar, and I'm making up these numbers again, 145.50, 144.50. Now all of a sudden we can see that our positions completely, or not completely, but change a little bit. Now we're exposed to half, or one unit of euro, 1 unit of pound, and 2 units of dollar. Now we can very simply do the math and say, well, 5% of my $2,000 trading account is $100. If 5% is my maximum, and 5% equals $100, and that means 1 unit, well, I need to take, according to my trading strategies, I need to sell short 2 units of the US dollar. That means that I cannot take 1 mini lot. I'm going to have to trade half a mini lot. 0.5, whoops, that's the wrong column, sorry. The pip value stays the same. What we look for is 0.5 on the position size, 0.5 on the position size. Now we have half a unit on the euro, half a unit on the pound, 1 full unit on the dollar. This helps us adhere to our trading strategy. Now, going back to Boyke's question, from this point moving forward, how do we guesstimate what profits are going to be, our goals for profit, our risk, etc.? Well, at the beginning of the webinar, we said, okay, let's open up a trading account, a demo account. Trade the same position size. Trade the same strategy. Try to make it as pure of a scientific study as possible. in the sense that if we were testing, a medical drug, we would get 30 patients, 30 people to test a drug, and we'd make sure that, as you can imagine, the blind study, everything would be as neutral and as kosher as possible, so to speak. You don't want any kind of information to diverge, to skew the results in any particular way. Same thing holds true with foreign exchange demo trading, or in demo trading any financial market. We want to try to take as many trades under the same criteria. We don't want to take an RSI trade and a euro-dollar trade. Now, in the previous Excel sheet, we showed you different strategies. That's, if you can trade multiple strategies on different demo accounts at the same time, if you have the wherewithal to do so, then you can go ahead and compare the results. But at least one strategy, or at the most, one strategy per demo account, a number of different currency pairs, place a trade during the day, during the night, all different trading sessions, try to get as much information as possible. At the end of the day, and this is not something that's prepared in an Excel sheet, but I'll explain exactly how we determine the risk. Well, we know how we measure the risk in terms of our actual positions. Here, I'm long half a euro, long half a pound, short one full US dollar. But at the end of the day, you take all the results on the Excel spreadsheets, and what you want to do, and I'll actually chat this in because I think it's kind of important. Okay, things to look for, to note on Excel spreadsheets. And this will give you, I hope, a better idea of the information that you're supposed to keep. Obviously, a high number of trades. High frequency of trades, so we get better statistical results. We want the same strategy and similar currency pairs. That's number 2. What we want to look for at the end of the day is you want to see, okay, number 3 is how much money was made or lost. Number 4, what was the max? What was the max P&L? Number 5, and these are things that I've used in Excel for a long, long time. What is the max drawdown? Explain what I mean. Let's say we start trading this strategy. Euro-dollar, RSI strategy. The first day we place a trade, we make 50 pips. The next day we lose 20 pips. The third day we make 70. The next day we lose 100. We go up and down, up and down, up and down. At the end of the month, we've placed 200 trades. Our demo account has made 2,000 pips. Forget about the position size. 2,000 pips. Now, that's great. Say, well, I think that's a good idea. We should start trading that with live money. But before we do so, what was the max? Let's say the max P&L, as high as the P&L got, the profit and loss, that might have been 4,000 pips. What is the max drawdown? The max drawdown is how much money we've lost going from the ultimate, the highest high of our profit and loss down to where we close at the end of the month. If I told you, yeah, I have a strategy, I traded it for a demo account for a month, and I made 2,000 pips, you'd probably say, great, share with me the strategy, I have money in my own account, I'm going to start making some money here. But what if I were then to tell you, yeah, the strategy made 2,000 pips, but it made as much as 5,000 pips in the first 2 weeks, and then finished the month only up 2,000 pips. What was the max? The maximum P&L? 5,000 pips. Where did we finish? 2,000. What is the drawdown? That's the max P&L minus where we ended the month. 5,000 minus 2,000 is 3,000. Now we have a strategy that made 2,000, but if you had started taking the trades at the worst possible time, you could have lost as much as 3,000. It's something that market strategists will refer to as the run-up to drawdown ratio. How much did the strategy make, and how much did it lose from its top? You want to have a positive run-up to drawdown ratio to be sure. If your account finishes 1,000 pips, at the end of the month, you don't want to have the drawdown more than 1,000 pips. As a general rule of thumb, I like to look for strategies that have, let's say, a 3-to-1 run-up to drawdown ratio, which means 3-to-1 is really not even that much. You're really looking for something 5-to-1, 10-to-1. where at the end of the day that the strategy makes 1,000 pips, but the worst, if you had started taking the trades at the worst possible time, let's say when it was at 1,200, it only went down 200 pips, from 1,200 to 1,000. 200 pip drawdown, 1,000 pip run up. That's a 5-to-1 risk, not risk reward, a run up to drawdown ratio. And we also obviously have to look at the risk reward. That is something that we use to approximate our risk. We can calculate really easily risk on a trade-to-trade basis because we say, yeah, the euro dollar, I'm buying at 133.50. I'm putting my stop at 132.50. With one mini lot, I'm risking 100 pips. One mini lot, $100. Yeah, that risk is easy. And it's even easy to calculate the risk with different currency pairs. But how do we know that the strategy itself is not going to blow us up? You know, we can have winning trades in a losing month. You can have a strategy. How many of you have traded a strategy that has, you know, you've damaged your accounts and you've suffered significant drawdowns, but at the end of the month the strategy makes money. And by the way, if we have $1,000 account and we've drawn down at the most 5%, 5% of $1,000 account is $50, and we're trading 5% positions, that means we know at the worst case scenario, our $1,000 account will only go down to $950 from peak to trough during that trading month. If we have a strategy that makes 2,000 pips in a month, but draws down 2,500 pips in a month, your $2,000 account risking 5%, you could very easily blow it up. As far as profit goals, well, you use the demo counts in the same way. So what's my run up to drawdown ratio? Let's say it's a 5-to-1. I made 1,000 pips. I had the worst drawdown of 200 pips at one time. That's a 5-to-1. And we can multiply that times our risk. We're risking 5% per trade. 5% of $2,000 is 100 times 5. We hope to make $500 in a month. And if we expect to make $500 in a month, well, we would expect to draw down a fifth of that, $100. And you can see how the math continues. Point being, and the point of really trying to hammer home during this entire webinar is the fact that we have a lot of different tools in our arsenal. We have education, we have courses, we have trading signals, we have, webinars, we have all this other good stuff. At the end of the day, I truly believe the power to make money, the ability to make money, the responsibility lies in our own hands. That once in a while a broker may give us a bad execution or a trading strategy might just, not work right because of unexpected news. Most of the time though, the power to make or lose money is in our hands. And I challenge you, pick one indicator, whether it's the RSI, the Bollinger Band, or anything else, that you can very simply create a set of rules that says, okay, I'm going to buy when this happens, I'm going to sell when that happens, commit to the demo account, and if you have another strategy that has proven to make money on a live account, you can obviously continue to trade live accounts. Aside from my live accounts, I always have other demo accounts running to test some new ideas. Trade the demo account for a good 30 days. Place a lot of trades, 100, 200 trades over the course of 30 days. You can keep track of those trades as you go on an Excel spreadsheet. It just takes, once you update the data, it just takes a few minutes. And at the end of the month, the results, they could be just what you expected, and then you can just continue to trade that way, and you know with greater certainty what to expect. They might be really, really shocking. In my own experience, I was convinced that the combination of these two indicators was really doing the best job at isolating the best trades, the most profitable trades. I found out that at best, those two indicators with all different stop limit combinations, at best, they were yielding a 50% profitability factor. I knew the time of day was important, but I didn't know how important it was, because it makes a difference between being right 90% of the time, between 9 to 10 a.m. Eastern, and being right only 13% of the time, between 10 to 11 a.m. Eastern. That's the beauty of trading, of demo accounts, of perfecting our arts. Think about it. You trade one new strategy, one new indicator on month on a demo account. At the end of the year, you have 12 strategies that are bulletproof. And 1 month, by the way, a lot of people will say it's not enough. You want to trade during different market conditions. Trading in the month of August is not like trading in the month of July. And it's not like trading in December as opposed to October. So 1 month would be the bare minimum. But really, you want to try to trade different market conditions to give you the best representative data. Unfortunately, I'm out of time. If you want to contact me directly, please feel free to do so. www.forexlounge.com. By the way, if you're interested in these Excel sheets, go to our forum. And in our forum, there's a trading course. Oh, we also have it, I believe, in FX Street as well. FX Street, I completely forgot about that. If you look under my name on FX Street, it's the same trading course, the same thing. And those Excel sheets, I believe, should be posted there as well. Contact me if you have any questions at any time. One of very special thanks to FX Street. Please see the calendar because we have a big month ahead of us. I want to thank you all very much for joining us. Wish you a great day, all profitable trades, and we look forward to seeing you back soon.